Welcome to Strategic Alternatives, the RBC Capital Markets podcast. I'm your host for this episode, Joe Coletti. Today I'm at RBC's Global Energy, Power, and Infrastructure Conference here in New York, and I'm speaking with Ben Rodgers, Executive Vice President and Chief Financial Officer of APA Corporation. APA is a global energy company operating across the world's most important energy basins, from the Permian in Egypt to the North Sea and Suriname. The company combines short-cycle development with long-cycle opportunities around the world, giving it a unique perspective on how energy markets are evolving. Today, we'll discuss how APA is navigating shifting energy demand, evolving capital priorities, global energy security, and the growing importance of execution in an increasingly complex energy landscape. Ben, thanks for joining us today.
Great to be here. Thanks for having me.
As you look ahead, what do you see as the forces that will really shape the next chapter for APA, but also the industry more broadly?
Sure. What happened back in 2014 when OPEC decided to increase production and you saw a sharp drop in crude prices, a lot of companies really battened down the hatches and stopped exploring globally for oil and gas. So there's been a decade of a lack of investment in upstream projects around the globe. And back in 2020, there was a lot of discussion around peak demand for oil in 2030. Recently, a lot of the large groups that were talking about that, government-funded groups and other analysts have now said that now is peak demand is 2050 or beyond. So we've got decades of growth of crude demand we know that the world is going to need. And we did not stop exploring for oil and gas, and we will not stop exploring for oil and gas. And we've got a great portfolio, and we think that as the oil market, especially in the U.S., starts to shift less focused solely on unconventional shale and more towards just where are the most capital efficient hydrocarbons and where can those be found and developed, we're already in those. And we've got opportunities in Suriname, we've got opportunities in offshore Uruguay. We're now on the north slope of Alaska and other areas around the globe, and really think that that portfolio diversity, not only in just the upstream asset, but geopolitically, is really going to set us apart.
So you mentioned geographic diversity there. What are you learning about the value of having that diversity in your business and with your resource assets?
We've got decades of experience in dealing with different countries, and there's political risk in every country. And you may think in one area, for instance, like in the North Sea, where we have assets, United Kingdom there was a great place to do business for a long time. And then in Russia-Ukraine conflict broke out in 22, the energy profits levy was put in place. And that burdened us so heavily with taxes and then different emissions requirements that were put in place. We stopped developing in the North Sea. If we were solely in the North Sea, that would be detrimental for our business. We're not solely in the North Sea. We've got anchor assets in the Permian, anchor assets in Egypt, soon to be in Suriname. And so having that diversity, not only across the commodity, but also in what we've seen as a very quickly shifting political landscape. And for us, we think that it's good to be diverse.
One theme that keeps coming up at our conference, specifically this year, is natural gas being re-rated, not being viewed as simply a commodity, but really as a source of energy security, LNG supply, and really power reliability. How does that shift in thinking around natural gas impact the long-term value of your resource base and how you think about it?
Yeah, we've got quite a bit of exposure to natural gas around the world. We produce a lot in the Permian Basin, and so we're exposed to the trading and the arbitrage that comes from having a low price in the Permian, but being able to sell that gas on the Gulf Coast. So we're able to make quite a bit of money, and we have for a few years now. We've got exposure to LNG pricing. We have a long-term sales contract with Cheniere. And so we've got exposure to both JKM and TTF. We know that there's a strong demand pull around the globe, and having balance of both TTF, which goes to Europe, JKM, which goes to Asia, we can kind of play those markets and have exposure to where we choose on an annual basis. We've been in Egypt for 3 decades with oil and gas, and we can actually deliver a lot of value to the country on that. We don't think that that's going to stop. It's not going to stop in Egypt. It's not going to stop in the US. You've got a big LNG pull that's going to come from the Gulf Coast, and that gas is going to be sent around the globe. And you've got, a strong population in the US that's going to use a lot of power. You've got AI demand that's going to be coming. It's an effort and futility to look at which analyst is going to be right on what that power demand is going to be, but we just know that that demand is going to continue to increase and is going to continue to draw the need for natural gas. So just like we think that demand for oil is going to grow well past 2050, it's going to continue to grow for gas. So we think we're well positioned to take advantage of both commodities. If there's a super cycle in one and it's flat in another, we'll have exposure to both of those.
How are you thinking about capital allocation across APA's portfolio? And what makes an investment opportunity in your mind compelling right now?
From an allocation perspective, we feel very good about what we're allocating to the Permian, what we're allocating to Egypt. I will say this year is a little light on the exploration side. That's just from a timing standpoint. It's not because of the prospects. Each of our exploration plays is on its own timeline. We entered Uruguay in 2023. We also entered Alaska in 2023. Very different development timelines if you get to a development on those assets. And then as you're spending exploration dollars, how those dollars are spaced out are also very different. But in 27, you will see an uptick for us in allocating more capital to exploration because of the timing of those. We're going to explore more in Suriname with Total. We're going to explore in Uruguay and in Alaska. And so keeping Permian and Egypt relatively flat really is the right thing because, 2 years from now, we'll have organic growth in Suriname. And all of that will allow us to continue to fund that exploration engine to allow us to find more crude and gas around the globe.
What have you learned about risk sharing, attracting capital, but also building the right partner ecosystem to execute at the scale that you guys need to execute at?
We like being positioned where we can have scale in the basin. And that brings economies of scale around capital efficiency, operating costs, supply chain, kind of how you operate the asset. We also like having the size to where if we would like to sell down a portion of it and share the capital burden with others, we can do that. We came into Suriname, we owned 100% of Block 58 in Suriname. We drilled our first exploration well, 100% risked on our own dollars before we brought Total in. We chose to take a different path for Alaska. We came in with Alaska. We own 50% of that. If you get to a large scale development at some point, 50% is still big enough to where you can sell, another 10, 20% and share those economics with someone else. In the Permian, we've got a very high working interest. In Egypt, a little over 10 years ago, we sold down a third of that business to Sinopec. And so we have a partner in Egypt. We've got a partner in Suriname. And so it's good to be balanced across the two, not only from a capital burden standpoint, but also from a learning standpoint. We brought Total into Suriname, and that was very strategic, very intentional. They are one of the top operators of FPSOs around the globe. We knew we would get to a development, it'd be an FPSO style development. And so bringing someone in like Total, who it's just in their DNA to do these type of large scale, large capital projects, that we could learn from that, but also hand the keys over to someone who's very adept at doing that. So we're very intentional about who we partner with, but it's got to be in the right basin and really at the right time for the project.
When you think about APA's long-term strategic focus, what does that look like in your mind? But also when you look out at some of the longer-term trends for the industry, how do those two impact one another?
The first thing that we have to realize is that change is inevitable. We knew about 2 years ago that we needed a change on the operating side for our anchor assets. And a lot of that had to start at the top. And so in January of last year, executive leadership team took the position and we reduced our officer count by a third. And that allowed other leaders in the organization to really step up and their voices were heard. That allowed us to drive so much change in all of our assets. We want to be an elite E&P. We are one of the few that does both E and P, stands for exploration and production. A lot of focus in the last 15 years on just the production side. We've been focused on both, and we now have the right leadership team in place. We're getting our cost structure to where it needs to be, and that's going to drive long-term value for at least the next 5 to 10 years for Apache, if not longer. And so when the market starts to give more value to conventional assets and the free cash flow that we can generate from Egypt and value towards underwriting and finding low-cost hydrocarbons around the globe on exploration assets, we'll continue to get more benefit from that from our stakeholders. And the number one thing we can do in the meantime is continue to execute on our plan, generate a lot of free cash flow like this year at high prices. And when prices are low, still generate free cash flow because we're a cost leader. But we're excited about what the future holds for us.
I think that's a great point to end on, Ben. Thank you so much for being with us. We wish you best of luck with the rest of your meetings and your time at the conference, and maybe we'll have you back on next year.
Great. Thank you.
Thanks for tuning in to another episode of Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on June 2nd, 2026. Listen and subscribe to Strategic Alternatives on Apple, Spotify, or wherever you get your podcasts. If you'd like to learn more or continue the conversation, please contact your RBC representative or visit rbccm.com/strategic alternatives. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.